Hey everyone, welcome to this explainer. I am absolutely pumped to guide you through this one today, because we're looking at a truly fascinating intersection in the market. We're going to unpack the hidden bottlenecks of the massive AI boom, figure out exactly how to read the dials on our valuation dashboard, and finally learn how to spot real, on-the-ground market momentum. If you've been watching tech stocks absolutely soar lately, and you're wondering what's actually powering the engine underneath, well, you're in exactly the right place.
So picture this, $145. That is the estimated cost of the memory alone for the next generation iPhone. To put that into perspective and show you why that number is so shocking, the memory in the current generation iPhone 17 Pro is estimated at a mere $39. That is an absolute explosion in cost for a single component. Tech giants aren't just going to eat a $100 increase per device out of the goodness of their hearts, right? They're going to pass that right along to us, the consumers. And honestly, this massive price hike is the first huge clue to a much larger crisis that's unfolding behind the scenes of the entire AI revolution.
Here is our roadmap for today's explainer. Number 1, the hidden AI bottleneck. 2, the memory chip monopoly. 3, decoding the forward PE. 4, the cyclical value trap. And 5, consumer sentiment and ELF. Let's get right to it.
Section 1. The hidden AI bottleneck. Skyrocketing memory costs.
You know, when we think of AI, we usually picture massive processors and futuristic software. But the unsung hero, and honestly the current choke point, is memory. Get this, Apple is reportedly seeking US clearance to buy memory from a Chinese supplier called CXMT, which happens to be currently blacklisted by the Pentagon. Just let that sink in for a second. The AI-driven shortage from memory chips is getting so wild that one of the largest tech titans in the world is desperate enough to consider trailing node suppliers, essentially companies making older, less advanced chip tech that are literally under strict government sanctions. When the biggest players on Earth are scrambling to find workarounds for basic components, you know you've hit a severe bottleneck.
Moving on to Section 2. The memory chip monopoly, lawsuits, and record profits.
So what happens when a bottleneck like this meets unbelievable pricing power? Well, a massive legal and economic backlash starts brewing. Right now, the big three memory chip producers, Samsung, SK Hynix, and Micron, are facing a class action lawsuit. They're being accused of colluding to artificially keep their supply low while demand was surging. The result of all this? Memory prices are rocketing to historical highs. And this isn't just some niche tech sector problem anymore. It's a massive macro threat, because when the cost of memory goes up, literally everything from your next laptop to your smartphone becomes way more expensive, which threatens to reignite wider inflation across the entire global economy.
The crucial point here is captured perfectly in the math. Take a look at Micron's recent performance. Their revenue growth has absolutely skyrocketed, up over 300%. But their cost of goods sold, that only went up by about 11%. They didn't magically figure out how to produce 300% more chips overnight. The prices they're able to charge have just exploded higher. This is the textbook definition of pure pricing power. They are making absolute fortunes right now, pulling in some of the highest margins you will ever see in the hardware space.
Section 3. Decoding the forward PE, the valuation dashboard.
To understand how we actually value these tech behemoths and find real investment opportunities amidst all this chaos, we need a reliable mathematical dashboard. Enter the forward PE, or forward price-to-earnings ratio. Think of this as a crucial speedometer for judging if a massive company is trading at a discount or a premium. It takes the company's current stock price and divides it by the earnings per share analysts expect them to make over the next year. It's a forward-looking indicator, helping us figure out exactly how much we're paying today for the profits of tomorrow.
A great way to use this is by setting the rule of 20 as our baseline for the market average. When you do that, the contrast happening right now in the market is just massive. Take Meta, for example. It's trading at a forward PE of about 17, which means it's actually at a slight discount compared to the broader market. That's largely because they're spending billions on future capital expenditures, and the market is pricing in a little bit of hesitation. But then, look at AMD. AMD is commanding a sky-high premium with a forward PE of 77. So how on earth can any company justify trading that far above the market average?
Well, a massive forward PE like AMD's is really only justified by one thing: explosive, triple-digit growth expectations that will rapidly eat up that multiple. Analysts expect AMD's earnings per share to grow by a staggering 163% this current year, and then follow that up with another 70% growth next year.
When a company's profits are essentially tripling year over year, that high forward PE of 77 is going to shrink down very, very quickly as those future earnings become reality. And that right there is exactly why investors are more than willing to pay that premium today.
Section 4. The Cyclical Value Trap. Counterintuitive Investing.
Let's combine these valuation lessons and reveal a really hidden danger in the hardware space. If we circle back to Micron, looking at their growth statistics on paper, you might think buying this stock right now is the greatest deal in the history of the market. They've got a wildly low forward PE of just 12, which is way below our market average of 20. And yet, their expected earnings per share growth for the current year is 758%, alongside a revenue growth of 268%. Low multiple, massive growth. I mean, it literally looks too good to be true, doesn't it? Well, actually, scratch that. It is too good to be true.
Here is the contrarian twist. With cyclical stocks, like memory chip manufacturers whose profits boom and bust right alongside hardware cycles, the absolute worst time to buy is usually when the math looks the cheapest. A classic rookie mistake is buying a cyclical stock when its forward PE is sitting around 10 or 12, because it usually means the company is already at peak boom. Sure, they're making a fortune right now, but the market knows a brutal down cycle is inevitably coming the second supply catches up to demand. The pro move? Surprisingly, it's buying cyclical stocks when their forward PE is sky high. That typically means their earnings have been temporarily wiped out by a brutal down cycle, but they're just about to rebound and start the whole profitable upcycle all over again.
Section 5. Consumer Sentiment and ELF. Spotting the Rebound. So we've looked at the massive booms in macro hardware, but let's shift gears completely to the micro road of everyday consumer spending. A very different cycle is playing out here. It's kind of funny, honestly. While tech billionaires are fighting in court over microchips, the rest of us are dictating market momentum one tube of lipstick at a time. If we map out a timeline of consumer health, we start at step 1 with the massive retail peak back in 2021. But then step 2 hit us hard. A brutal inflationary spiral crashed consumer spending and dragged retail stocks down for years. However, if we look at recent data, specifically the widely tracked Michigan Consumer Sentiment Index, we've recently hit step 3. A definitive, crystal-clear bottom reversal. Sentiment has finally stopped falling and is curling upward. That sets us up for step 4, an expected 12 to 24-month trajectory where consumer health steadily rebounds, bringing all those beaten-down retail stocks right along for the ride.
Let's take e.l.f. Beauty as a prime example. After a pretty brutal down cycle, the stock hit a crystal-clear bottom at roughly $49. And then, it beautifully illustrated this return of momentum by bouncing up over 42% in just 3 weeks. When sentiment turns, these moves can be rapid and dramatic. And it's definitely not just e.l.f. If this consumer rebound trajectory holds, we're looking at massive potential for other beaten-down blue-chip brands that have been totally out of favor for years. Companies like Nike, Estée Lauder's, Lululemon, Target, stocks that people only really want to own when the everyday consumer feels confident enough to open their wallets again.
We've covered a ton of ground today, right? From the desperate rush for high-bandwidth memory chips pushing hardware costs into the stratosphere, to the counterintuitive math of valuing tech giants, all the way down to the incredible momentum finally returning to consumer retail stocks. This leaves us with one final, urgent question to consider as you navigate the hidden mechanics of this high-energy market cycle. As AI memory costs surge and consumer sentiment rebounds, where will you look for the next crystal-clear bottom? Thanks so much for joining me on this explainer. I really hope it completely shifts how you view the market engine. Keep looking at the data, and I'll catch you next time.